Visualize this scene. November 2025. You're witnessing Nvidia ascend to yet another all-time peak. Your investment portfolio, after a prolonged period of anticipation, finally shows positive returns. The artificial intelligence revolution appears unstoppable, with financial analysts forecasting even loftier targets. Then, a revelation surfaces that fundamentally alters your perspective. Stanley Druckenmiller, the esteemed investor, renowned for transforming $12 million into $12 billion, the very individual who foresaw this widespread AI surge back in 2023, has just submitted his quarterly 13F filing with the Securities and Exchange Commission. You navigate to his Nvidia holdings, expecting to find millions of shares. Instead, you encounter a figure that causes your heart to plummet. Zero. Not a partial divestment, not a strategic profit-taking maneuver, but a complete withdrawal. While you were enthusiastically acquiring shares during the rally, he was orchestrating his exit. And here's the truly alarming aspect of his timing. By the time you read about his disposition in the news, the transfer of capital has already concluded. His billions are securely held in cash or have been strategically reinvested elsewhere. Your capital has effectively provided the liquidity for his departure. Allow me to elucidate why this isn't merely another instance of a billionaire liquidating assets. This signifies astute capital, signaling the market's apex. The vast majority of investors are entirely missing this crucial indicator. You've likely encountered the comfortable rationale presented by the financial media. Druckenmiller is simply securing profits following a successful run. He's rebalancing his portfolio. This represents standard position management. These explanations sound plausible until one grasps Druckenmiller's operational methodology. This is a man who retained his Amazon shares throughout the entire 1990s, witnessing their substantial appreciation. He held Facebook stock for years during its period of market dominance. When he identifies a genuine paradigm shift, he sustains his investment until the underlying fundamentals evolve. He does not divest from successful holdings merely due to their price appreciation. He sells when the prevailing narrative is no longer tenable. Consider the profound implications of his zero stake. According to SEC disclosures, Druckenmiller's family office, Duquesne Capital, maintained significant Nvidia investments throughout 2023 and into 2024, capitalizing on the AI chip phenomenon he had publicly predicted. Subsequently, in the third quarter of 2025, he systematically divested the entire position. This is not the action of a short-term trader seeking quick gains. It reflects the strategy of a macroeconomist anticipating the conclusion of a paradigm. Understanding the mechanism is paramount. When prominent fund managers intend to divest a substantial holding, they encounter a significant challenge. If Druckenmiller were to publicly announce on television his belief that Nvidia is overvalued and that he is liquidating his entire position, the stock price would likely plummet before he could execute even a fraction of his exit strategy. The very act of selling would undermine the value he aims to preserve. Consequently, they employ a different approach. They sell into strength. They liquidate their holdings amidst prevailing optimism. They divest during periods of heightened speculation when retail investors are aggressively entering the market, thereby supplying the necessary liquidity for their exit without precipitating a drastic price decline. The financial industry has a specific term for this phase: distribution. The informed investors strategically distribute their shares to the public while celebratory sentiment prevails. This pattern is discernible throughout market history. Permit me to illustrate with a particularly relevant parallel, as Druckenmiller has executed this exact maneuver previously. Recall the dot-com bubble. In 1999, technology stocks were experiencing exponential growth fueled by the promise of the internet revolution. Sound familiar? Druckenmiller adeptly navigated that trend, generating substantial profits for George Soros's Quantum Fund. He understood the transformative potential of the internet and positioned himself early. However, the critical point is this: in late 1999 and early 2000, precisely as the bubble reached its zenith of euphoria, he began liquidating his technology holdings. Not because the internet's impact was illusory, but because valuations had become detached from economic reality. The Nasdaq index peaked in March 2000. Within 2 years, it experienced a 78% decline. Druckenmiller was not caught in that downturn. He had already shifted his strategic stance. Now observe our current environment. The AI revolution is a tangible phenomenon, much like the internet was in 1999. Nvidia's chips are indeed instrumental in powering the infrastructure that facilitates this transformation. However, here lies the insight Druckenmiller possesses that eludes most investors: the distinction between a genuine technological advancement and sustainable stock valuations at a specific juncture in the market cycle. When he divested from technology stocks in early 2000, critics accused him of missing the new paradigm, arguing that the internet would revolutionize everything. They were correct about the technology's impact, but catastrophically mistaken about the market timing. Investors who succumbed to the hype and held through the subsequent crash lost their entire investments. Those who emulated Druckenmiller's strategic foresight preserved their capital and subsequently acquired assets at significant discounts 2 years later. His third quarter 2025 divestment from Nvidia mirrors this historical precedent. He has witnessed this market dynamic before and strategically exited before the inevitable downturn. Consider the implications for your current portfolio. If you hold Nvidia or other AI-related investments, you're essentially making a wager that your understanding of the technology sector surpasses that of an individual with 40 years of experience, access to proprietary information, direct engagement with chief executive officers and policymakers, and a proven track record of navigating multiple market bubbles and crashes. You are betting that when he declares, "I am out," he is somehow incorrect regarding the timing. While this is a theoretical possibility, let us examine the historical probability. Research conducted by the National Bureau of Economic Research indicates that when legendary investors with over 30 years of successful track records initiate significant portfolio adjustments, their timing is accurate approximately 70 to 80% of the time over a 12-month horizon. These are not speculative gambles. They are informed decisions predicated on the flow of private information, pattern recognition honed over decades of experience, and access to analytical resources unavailable to the average retail investor. You are not operating on a level playing field. You are becoming aware of his strategic moves months after their execution, making investment decisions based on delayed information, while he has already established positions for the subsequent market phase. Herein lies another critical aspect that many overlook regarding these insider divestments. Druckenmiller cannot directly inform you of impending challenges. If he were to appear on television and declare that the AI bubble is on the verge of bursting and that everyone should sell, he would face regulatory scrutiny and potential legal repercussions. Consequently, astute investors communicate through actions rather than words. Their 13F filings represent the closest approximation of a direct warning, provided one is attentive and possesses the understanding to interpret them. His zero stake in Nvidia serves as a conspicuous red flag. While he was divesting throughout the third quarter, what was transpiring in the media? Analysts were elevating price targets. Technology influencers were celebrating new highs. Retail investors were channeling funds into AI stocks, convinced they were investing in the future. This divergence, the informed investors exiting while retail capital flows in, is the quintessential hallmark of a market peak. You might be contemplating, but Nvidia's earnings remain robust, revenue is growing, and the AI infrastructure build-out is a tangible reality. All of these assertions can be true concurrently, with the stock being significantly overvalued. Druckenmiller is not disputing the importance of AI. He is questioning whether Nvidia, at its current valuation, offers attractive future returns relative to the perceived risks building within the broader economy. This is where the narrative takes a more somber turn. Upon examining his other divestments and the reallocation of his capital, it becomes evident that his Nvidia exit is not an isolated transaction, but rather an integral component of a comprehensive defensive repositioning in anticipation of his projections for 2026. This individual is meticulously preparing his entire portfolio for an economic downturn that the majority of Americans have yet to anticipate. The distribution phase is complete. The informed capital has departed. We are poised to witness the consequences for retail investors left holding assets at the zenith of the most expensive technology market in American history. Allow me to demonstrate why this extends far beyond a singular stock transaction. A thorough examination of Druckenmiller's complete portfolio adjustments in the third quarter of 2025 reveals a development that should prompt every technology investor to pause and re-evaluate their entire strategy. Nvidia was not the sole casualty. According to his 13F filing, he also liquidated his entire stake in Palantir, another prominent AI company that Wall Street analysts have been enthusiastically endorsing for months. He significantly reduced his holdings across a spectrum of high-growth technology enterprises. This indicates not a company-specific concern regarding Nvidia's competitive standing or Palantir's government contracts, but rather a systematic divestment from the entire growth and AI sector within his portfolio. Ponder the implications of this pattern. When a renowned macro investor exits a single overvalued stock, one might interpret it as profit-taking. However, when such an investor divests from an entire sector concurrently, it constitutes a definitive statement about the prevailing macroeconomic conditions. It signals that the fundamental drivers that propelled these stocks to unprecedented heights, readily available capital, accommodative monetary policy, and euphoric market sentiment, are poised for a precipitous reversal. Do you require corroboration that this is a defensive macroeconomic maneuver? Observe the destination of the capital. While Druckenmiller was liquidating his AI positions, he was simultaneously establishing significant holdings in gold mining companies and precious metals equities. For those unfamiliar with the investment philosophy of billionaire investors, this strategic rotation conveys a very specific message. Gold and gold mining stocks are quintessential defensive assets that tend to outperform during periods characterized by high inflation, currency debasement, or significant financial system stress. When an individual with Druckenmiller's distinguished track record shifts billions of dollars from high volatility technology stocks into inflation hedges, it indicates preparation for a severe economic downturn or a stagflationary environment. He is transitioning from paper assets to tangible assets, from speculative ventures to capital preservation, from an offensive to a defensive posture. Data from the World Gold Council reveals that institutional investors increased their gold allocations by the largest percentage in over a decade during 2025. Druckenmiller is not alone in this strategic shift. He is, however, among the earliest and most assertive participants. The informed investors are constructing robust defenses while retail investors are still engaged in market revelry. Now permit me to explain the specific catalyst that likely prompted his divestment, as this is where the situation becomes mathematically undeniable and the risks become unavoidable. The AI boom precipitated a massive capital expenditure cycle. Corporations such as Microsoft, Google, Amazon, and Meta have collectively allocated hundreds of billions of dollars toward the development of AI infrastructure. Over the preceding 2 years, they have been acquiring Nvidia chips in substantial quantities, constructing expansive data centers, and aggressively deploying AI capabilities to outpace their competitors. This expenditure fueled Nvidia's revenue to record levels and justified its valuation exceeding $1 trillion. However, here lies the challenge that Druckenmiller perceives on the horizon, what Wall Street terms the ROI cliff. These corporations have invested extensively in AI infrastructure with the expectation of generating substantial returns through novel products, operational efficiencies, and competitive advantages. According to recent surveys conducted by McKinsey and Goldman Sachs Research, the majority of enterprises are still in the experimental phase of AI adoption. They have yet to realize the productivity gains or revenue generation that would substantiate continued massive investments. Consider this from the perspective of a chief financial officer. You have expended $50 billion on AI infrastructure over a 2-year period. Your shareholders are now inquiring, where are the profits? When will this investment begin to yield returns? If the candid response is, we are not yet certain, but we must continue to invest billions more, how long before the board of directors begins posing more pointed questions? Druckenmiller anticipates the approaching juncture where major technology companies will curtail chip procurement at the current pace. They may not cease entirely, but if orders decline by even 30 to 40% as companies pause to assess their AI investments, what will be the consequence for Nvidia's growth narrative? The stock is currently priced for perpetual acceleration. Any deceleration will be met with severe market repercussions. Financial models developed by analysts who meticulously review the footnotes in technology companies' 10-K filings suggest that we are approaching a natural plateau in the AI infrastructure build-out cycle. The initial phase of expenditure is largely complete. The subsequent phase hinges on demonstrating that the initial investment generates tangible returns. If such proof does not materialize in early 2026, the purchasing will cease and Nvidia's revenue growth will contract sharply. This represents a mathematical predicament. Druckenmiller is not predicting the failure of AI as a technology. He is forecasting a temporal gap, potentially extending to a year or more, between the infrastructure investment phase and the monetization phase. During this interval, Nvidia's stock price could conceivably decline by 50% or more as investors re-evaluate the company based on decelerating growth rates rather than the perpetual acceleration they had assumed. He is unwilling to endure such a drawdown, hence his strategic withdrawal before the music stops. However, here is what should genuinely concern you about the current market conditions. Druckenmiller's action is not occurring in isolation. When one broadens the perspective to encompass insider selling across the entire technology sector in 2025, a coordinated withdrawal by those with the most intimate knowledge of these companies becomes apparent. Jeff Bezos has been systematically divesting Amazon stock at an unprecedented rate throughout 2025, unloading billions of dollars worth of shares. Mark Zuckerberg has been progressively reducing his Meta holdings through pre-arranged trading programs. According to SEC filings compiled by insider tracking services, aggregate insider selling within large technology companies has reached levels not witnessed since early 2000, immediately preceding the dot-com crash. Executives and major shareholders possessing the clearest insight into their company's actual performance and future outlook are heading for the exits. Now, you may encounter a counter-argument. These billionaires must diversify. They have estate planning obligations. This is simply routine portfolio management. While these factors are partially true, the data reveals a more profound reality upon deeper investigation. The pace and scale of selling in 2025 are 3 to 4 times higher than the average observed over the preceding 5 years. This is not routine diversification, it signifies urgency. These insiders are not merely selling small portions, they are liquidating all possible holdings while maintaining corporate control. They are capitalizing on near-record valuations to convert stock into cash at a rate that suggests they do not anticipate these prices persisting. And here is the mechanism that renders this exceedingly perilous for ordinary investors. When corporate insiders and legendary hedge fund managers are all divesting, who is acquiring these assets? It is you. It is your 401k. It is your index fund. Retail investors and passive investment vehicles are absorbing the supply that the informed investors are desperately attempting to unload. Data from the Investment Company Institute indicates that retail investors collectively invested over $300 billion into equity funds during 2024 and 2025, representing one of the most significant retail buying waves in history. Concurrently, hedge funds and institutional investors have been net sellers. The transfer of wealth is occurring in real time, and most Americans are entirely unaware that they are on the losing end of this transaction. Consider the implications for 2026. If Druckenmiller's projections regarding the timing are accurate, and if the recession or credit stress he is preparing for indeed materializes, what will be the fate of the numerous retail investors who purchased at the market's apex? They will be holding overvalued technology stocks and portfolios that could readily depreciate by 40 to 60%. Meanwhile, the informed investors will be safely positioned in cash, gold, and defensive assets, prepared to acquire investments at bargain prices during the ensuing panic. This is how generational wealth is transferred, not through intricate derivatives or esoteric strategies, but through fundamental market timing. Experienced investors divest near the peak, selling to less experienced investors who believe the rally will continue indefinitely. Subsequently, when the inevitable market correction occurs, the seasoned investors repurchase those same assets at substantial discounts from the inexperienced investors who panic sell at the bottom. Druckenmiller's divestment from Nvidia is not solely about a single stock. It signifies an understanding of our current position within the market cycle and a refusal to serve as the liquidity provider for the next wave of investors left with depreciated assets. The crucial question you must pose to yourself is, on which side of this transaction do you wish to be when 2026 arrives? Allow me to present the quantitative evidence that underpins Druckenmiller's market outlook, for once you grasp the numbers, his strategic exit becomes entirely logical and the inherent risks become unavoidable. As of late 2025, Nvidia is trading at a price-to-earnings ratio that is approximately double its historical average. The stock is priced for an ideal scenario, assuming perpetual growth, zero competition, and an AI revolution that accelerates without any interruption. Wall Street analysts attempt to justify this premium by emphasizing the paradigm shift brought about by AI, asserting that traditional valuation metrics are no longer applicable. You have heard this narrative before if you studied the dot-com bubble, where analysts offered similar rationales for internet stocks. This is what transpires when paradigm-driven premiums evaporate. When investors cease to believe in the narrative of sustained growth and begin to demand traditional financial fundamentals, stocks undergo a phenomenon known as mean reversion. They revert to their historical average valuations. For Nvidia, if we exclude the AI hype premium and the stock were to trade back to its median price-to-earnings ratio from the preceding decade, the resulting valuation would be approximately 50% below current levels. Consider the financial implications. If you currently hold $100,000 worth of Nvidia stock, mean reversion would reduce that amount to $50,000. Half of your capital would vanish. This would not occur due to the company's failure or the ineffectiveness of AI, but simply because the stock's valuation returns to a conventional multiple that reflects realistic growth expectations rather than speculative euphoria. Herein lies the true significance of Druckenmiller's timing. Markets are inherently forward-looking mechanisms. They do not await the arrival of negative news. They price it in months in advance. Professional investors like Druckenmiller constantly assess anticipated market conditions 6 to 12 months into the future. When he divested in the third quarter of 2025, he was positioning himself for his expectations of mid-2026. So, what does he foresee for 2026 that prompted his exit in late 2025? Data from the Federal Reserve and the Bank for International Settlements indicates that we are approaching what financial analysts refer to as the corporate refinancing wall. Throughout 2020 and 2021, companies borrowed substantial sums of money at historically low interest rates, often below 3% for investment-grade debt. These loans typically have 5-year terms, meaning they will begin maturing in 2025 and 2026. Companies are now compelled to refinance this debt, but current interest rates are double or triple those that were previously paid. Imagine you are a chief financial officer who borrowed $10 billion at a 2.5% interest rate 5 years ago. Your annual interest expense was $250 million. Now that debt is maturing and you must refinance, but prevailing rates are 6%. Your new annual interest expense will be $600 million, an additional $350 million in costs that will directly impact your profits and free cash flow. When this dynamic is multiplied across thousands of companies and trillions of dollars in maturing debt, the magnitude of the problem becomes evident. Corporate profit margins are poised to be severely impacted by increased financing costs. As profits decline, stock prices invariably follow, and the highest valued stocks with the most optimistic growth assumptions, such as Nvidia, will experience the most significant declines due to their greater potential for contraction. Druckenmiller perceives this credit strain escalating throughout 2026. His late 2025 exit provides him with a 6-month advantage before these realities manifest in earnings reports and market valuations. By the time CNBC begins discussing profit warnings and downward revisions in mid-2026, he will be strategically positioned to acquire assets at 50% discounts while others are engaged in panic selling. This is the distinction that separates legendary investors from the rest. They do not react to news. They anticipate it and position themselves accordingly. However, the truly alarming aspect, one that most investors have entirely overlooked, is this. This is precisely where Stanley Druckenmiller's departure serves as a critical, systemic alarm rather than merely a shrewd financial maneuver. When the market downturn materializes in the year 2026, the underlying dynamics will diverge significantly from those of prior collapses, primarily due to the composition of the participants remaining. Reflect upon our prior discussion. Stanley Druckenmiller and his firm are no longer involved. Other prominent figures in the hedge fund realm have also divested. Corporate insiders are likewise disengaging. The seasoned capital has meticulously unwound its positions throughout 2025, reallocating to liquid assets or more conservative holdings. Consequently, when the sell-off commences in 2026, coinciding with the materialization of recessionary anxieties and a rush by investors towards the exits, who will be present to acquire these assets? There are no substantial buyers poised to capitalize on declining prices, having already deployed their available funds during their exits in 2024 and 2025. The customary stabilizing force during market upheavals, the well-capitalized institutional investors who typically intervene to purchase assets when widespread panic ensues, will not be stepping in this time because they have already withdrawn their capital. What will emerge instead is what market participants refer to as a liquidity vacuum. This occurs when there are overwhelming volumes of sell orders but a near complete absence of buy orders at any price point close to prevailing levels. The market will not experience a gradual depreciation. Rather, it will plummet precipitously as each price tier is exhausted instantaneously with no significant buyers materializing. According to analysis conducted by the Bank for International Settlements, such liquidity vacuums during market crises can precipitate declines of 20 to 30% within single trading sessions when the fundamental market architecture disintegrates. Envision the practical manifestation of this scenario. You awaken one morning in mid-2026 to discover that a company like Nvidia has fallen 15% in pre-market trading, driven by recession fears and underwhelming financial projections. Your initial thought might be, this is likely a temporary dip. However, by the time the market officially opens, the stock has already dropped 22%. You attempt to divest, but your order remains unfulfilled due to a lack of buyers at that price. The stock continues to slide down to negative 30%, then negative 40%. You are then forced to witness the erosion of your entire life savings in real time, utterly incapable of exiting your position due to the absence of any available liquidity. This is the consequence of astute capital withdrawing before a crisis unfolds, rather than during it. They effectively remove the very liquidity that normally serves to prevent a complete market collapse. Stanley Druckenmiller's action is not solely about safeguarding his personal holdings. His departure, in conjunction with the withdrawals of thousands of other institutional players, effectively eliminates the safety net that would typically arrest a precipitous decline in asset values. And here is what you must comprehend regarding your current investment standing. If you are currently holding positions in Nvidia or other high-valuation technology stocks, you are, in essence, making a wager against several uncomfortable realities. You're betting that Stanley Druckenmiller's assessment of the 2026 timeline is inaccurate. You're betting that the impending debt refinancing challenges will not negatively impact corporate earnings. You are betting that the surge in artificial intelligence expenditure will continue unabated indefinitely. You are betting that the market will somehow sustain its present valuations despite a deterioration in the broader economic landscape. Most critically, you are betting that you will possess superior timing or acuity compared to everyone else when the selling pressure begins. You are operating under the assumption that you will accurately identify the onset of the market correction and successfully execute your exit strategy before prices experience a dramatic downward gap. However, historical precedent demonstrates that individual retail investors are almost invariably the last to liquidate their holdings. You are receiving your market intelligence from news outlets which report on events that have already transpired, whereas astute investors are making decisions based on anticipated future developments. According to research undertaken by Dobar Incorporated, an entity that scrutinizes investor behavior, the typical retail investor underperforms the broader market by approximately 4% annually, largely attributable to suboptimal timing, purchasing at elevated levels, and selling at depressed values. During market downturns, this timing discrepancy widens considerably. Retail investors conventionally liquidate their positions after stocks have already declined by 30 to 40%, thereby solidifying substantial losses, while professional investors often divest near market peaks. You are contending with individuals like Stanley Druckenmiller, who possess 40 years of market experience, access to proprietary information, established relationships with corporate executives and policymakers, and sophisticated risk management frameworks. The notion that you will somehow manage to time your exit more effectively than he is, from a statistical perspective, virtually implausible. Therefore, allow me to be unequivocally clear regarding your present options. Option 1 involves disregarding this warning entirely. You may convince yourself that the current circumstances are unprecedented, that artificial intelligence represents a genuine paradigm shift justifying any valuation, that Stanley Druckenmiller is merely exhibiting excessive caution, and that you will be adequately protected by maintaining your current holdings through any ensuing market turbulence. History strongly suggests that this approach culminates in detrimental outcomes for you, but ultimately the decision rests with you. Option 2 entails acknowledging the signals being conveyed by astute market participants through their actions. You can recognize that when celebrated investors who accurately predicted the artificial intelligence boom are now divesting entirely, they are perceiving something that has not yet manifested in public discourse. You can emulate Stanley Druckenmiller's strategy by safeguarding your capital at this juncture, accepting the possibility of foregoing some additional gains should the current rally persist for a few more months, but thereby preserving your wealth for the anticipated market depreciation in 2026. Consider the inherent risk-reward calculus of these scenarios. If you elect to remain invested and Stanley Druckenmiller proves incorrect, you might realize an additional 10 to 20% gain over the ensuing months before the market potentially peaks. Conversely, if you divest now and Stanley Druckenmiller is proven correct, you will circumvent a 50% drawdown and preserve $50,000 for every $100,000 invested. The disparity in potential outcomes is exceptionally clear. You are risking catastrophic losses for the prospect of modest gains. Protecting your capital, in practical terms, means adapting your investment strategy. It does not necessitate liquidating all assets and retreating from the market. It involves recognizing that we are in the late stages of the economic cycle and adjusting your portfolio accordingly. This might involve reducing your exposure to technology stocks from 60% to 30%. It could involve realizing some profits and reallocating to cash or treasury bills, which currently offer yields of 4 to 5% with minimal risk. Alternatively, you might consider increasing your allocation to gold or defensive sectors that have historically demonstrated resilience during economic downturns. The precise allocation will depend on your individual financial circumstances, but the underlying principle remains consistent. Cease pursuing an overvalued market. The informed investors have already signaled the peak. The distribution phase is complete, and you have a limited window, perhaps a few months, before the economic realities that they are anticipating become evident in official data and market valuations. According to the research of Nobel laureate economist Robert Shiller concerning market bubbles, the precursors to a crash are invariably discernible, yet the majority of investors overlook them because the prevailing short-term trend appears favorable. Prices continue to ascend even as the underlying fundamentals deteriorate, fostering a psychological trap wherein investors mistake market momentum for fundamental validation. Subsequently, when the market turns, it transpires with astonishing rapidity because a collective realization prompts a simultaneous urge to exit. We are presently situated within this final phase of a bubble market. Prices are still climbing analysts maintain optimistic outlooks, and retail investors continue to deploy capital, yet the bedrock is eroding. Corporate executives are divesting, prominent investors are withdrawing, and refinancing pressures are escalating. The anticipated decline in artificial intelligence return on investment is approaching, and the liquidity that typically cushions market declines has already vanished. Stanley Druckenmiller's third quarter 2025 filing has provided a valuable insight. He has clearly demonstrated his perspective on the current market and his positioning for the year 2026. The majority of investors will either dismiss this signal or rationalize it away, fabricating justifications for why they possess superior foresight compared to a billionaire with a 4-decade history of successfully navigating market bubbles and crashes. Do not become that investor. Do not serve as the liquidity that facilitates his exit. Do not be the individual who awakens in mid-2026 questioning how they managed to overlook the abundant warning signs that were readily apparent. Time is of the essence. The sophisticated investors have already departed. The question is not whether a market reset is imminent, but rather whether you will position yourself to navigate it successfully or become another casualty in what will likely be the decade's most significant wealth redistribution event. The ultimate decision rests with you, but you are now privy to the knowledge held by the wealthiest investors. Your subsequent actions based on this information are entirely your prerogative.